S. Naren. He's Chief Investment Officer with ICICI Prudential AMC. Naren, good morning. Thank you for joining us. Naren, the environment is slightly challenging. Nothing has changed when it comes to the macro setup, but markets are holding on.
Yeah, actually that's the most surprising thing, because the last Tuesday's Reserve Bank action actually resulted in all the fixed income markets falling off, whereas the equity markets have seen in fact complete stability, and in fact last week the markets went up. So this has been a source of surprise to us as well, but as you know, domestic positioning over the last 6 years, people have absolutely gone underweight equities domestically. And so what happens is there is virtually no speculative position in the equity markets. And I guess that has helped the markets significantly. Although if they follow up on the monetary policy action by increasing short-term action, I don't think it's really positive for equities in the near term.
Naren, we've discussed this one in the past, that why markets are extremely polarized, and a polarized market is not a healthy market. But the bottom line here is that those who are buying pharma and FMCG stocks are making money. Those who are buying metals and PSU banks are not making money.
Yeah, that's been a trend now for 1 year. I mean, what we've seen from our past experiences, that doesn't work that way, as you know from the experience of both 2000 and 2007. But the fact is that you have this kind of situation whereby, we used to think consumer stocks were trading costly at 32 PE. Now they moved to 40 trailing PE. And still those are the stocks which are going up. So it's the kind of situation that the market is in at this point of time. I don't think it's a very healthy market, because if you're not going to see that kind of rotation, I don't think it's very positive.
Naren, what's happening with the banking pack? I mean, sure enough, there have been some earnings from some of the key participants wherein, the top and the bottom line has been in line, but it's the asset quality concern which clearly seems to be weighing heavy on some of these names. Do you think that is a concern that we'll have to live with for some more quarters?
See, we've been underweight on the banks for the last 3-4 years, but having said that, I think last Tuesday's event seems to have taken the situation as though only banks will bear the entire brunt. That's not true, because if you're going to have higher interest rates in the economy, I think other sectors are going to suffer far more than banks, because banks are going to get some pricing power if they choose to exercise it. So I don't know why the market has reacted in such a way as though banks are the only people who are going to get hurt. No one else will get hurt. So my reading is, if they were to implement what was agreed last Tuesday in the form of much higher short-term interest rates, I think we're going to see a far bigger impact on the economy. But at the same time, I think the problems of rupee continuously depreciating may come off. That would be the flip side of it. But I don't think the market is believing in, because if you see what's happening, tech is actually doing well, pharma is doing well, and banks are doing badly.
So Naren, are you using the current carnage in financials to your advantage to buy into good quality banks, maybe some NBFC stocks, maybe good quality private banks which have been beaten black and blue only because of sentiment, not because of earning concerns?
Yeah, actually, since we are underweight, we are looking at the point to bottom fish at this point of time. But at the same time, you don't know, given the fact that, it's still a very large component of the index, and the holdings of financials by FIIs are at record. You don't know what whether you should do it at one go or do it over a period of time. We believe we should do it over a period of time, given the huge ownership of financials. But the basic point that we are not able to understand at this point of time is, why is the market only focused on financials for this entire carnage, when in our opinion the outlook for growth in the near term is certainly much dimmer than what we've seen.
Naren, let's stay with FMCG. Several institutional investors are of the view that FMCG stocks are expensive, at least the large cap FMCG stocks, and I know your thoughts that you even find those stocks expensive. But what explains so much of price action and momentum in names like HUL, ITC, Nestle? These are not retail dominated stocks. These are institutional dominated stocks. So which are some of these institutional investors who are buying into these large cap stocks?
Actually, you should ask those institutional investors, because in our view, we have taken a position quite some time back that we believe these sectors are overvalued. And today I'm getting stocks, for example, in the PSU space, absolutely cash-rich companies trading at 6% dividend yield and 5-6 P. So why should I go for 35 to 40 PE trailing PE stocks with the same 2-3% dividend yield when I'm getting much cheaper stocks in the market at this point of time? But somewhere this trend is caught on, and I don't think you have to ask the buyers, because my experience in 2007 suggested that if you buy very overvalued stocks, sometimes you go through many years of underperformance, as we have seen already in the capital goods and power utilities pack. So my view has been that we have to be cautious in these sectors, because I don't think you can make big absolute returns in 40 PE stocks with $50 billion market cap kind of companies or $30 billion market cap kind of companies. So I don't know whether that is likely, but the fact is the trend in the last 1 year has been like that.
What's the call on IT then, Naren? I mean, Infy has surprised on the upside. TCS, no surprises there, has always been a stupendous performer. Do you think there is more upside in the sector right now? And would it make sense for anyone to get into the sector now for a buy?
So actually, one of the analysts had done a piece. Currently, the IT pack trades at 50% discount to FMCG pack on price to earnings. The normal, it seems, is around 25 to 30%. So almost IT on a valuation basis is far cheaper than consumers at this point of time. So we've been obviously much more constructive on IT than we have been on consumers, because we find that sector has valuations. In fact, most of the mid caps in the sector actually trade at single digit valuations, so giving us opportunities. So we've been positive on the sector. You know, today if you look at it, some of the leaders there are talking about growth rates of more than 14-15%. We are not able to meet a domestic sector today, which can generate a growth of even 7-8% this year. So in that situation, obviously even whether a value investor or growth investor, both are being led into tech at this point of time.
Well, Reliance is down, TCS is not contributing, and Nifty is not falling. Well, that's largely because of IndusInd Bank, Maruti, Bajaj Auto and Coal India. Coal India could be bouncing back, but Bajaj Auto was a big mover on Friday. Maruti numbers are due today. Naren, because monsoons are better this year, is there a case to buy into two-wheelers now? Good monsoon means good crops means rural income will go up. If rural income will go up, discretionary spend will pick up.
Yeah, actually there should be some, but if you see some of the stocks in the sector, they've actually done 20%. If you go back 1 year back and ask people what would be the growth rate people were expecting were far higher than what happened. But still the stocks have delivered 20%. So the point is that do we believe that the valuation is reasonable? Yes, it is reasonable. But is it undervalued? I don't think it is undervalued.
Naren, good having you on the show. And thanks as always for taking time out and joining us on the show today.